Hello and welcome to Reverse Mortgages 101, what seniors need to know about reverse mortgages. And again, welcome. This will be presented by myself, Bob Fleming. I am the manager and senior loan officer at Advisory Home Loans here in Fresno, California. I'm also a current board member and the immediate past president of our parent company, the Community Housing Council of Fresno. So, what is a reverse mortgage? It's a loan designed to help seniors stay in their home and age in place. And I don't know about you, but for me, the idea of staying in my home until the end and not having to move into some kind of facility or something is very appealing. And I believe most people feel the same way. And so again, this came out in 1989 and was signed into law by Ronald Reagan. And the FHA, when FHA got involved, it really cleaned up the industry. And the vast majority of the loans that we do today are FHA. So what does a reverse mortgage do? A reverse mortgage, first and foremost, if there's an existing lien, it will pay off any existing mortgages and liens. It may also provide a line of credit, may provide a source of additional monthly income to supplement Social Security and or any other retirement, may provide a lump sum of cash, and in some cases you can do a combination of all of the above. And one of the things I like the most is a little known fact: you can also purchase a home using a reverse mortgage. So let's compare. A regular mortgage or a forward mortgage, there are payments made. The principal balance reduces each month and you receive a monthly statement. So of course you can see that your payment was reflected and the balance was lowered. On a reverse mortgage, there are no payments made, although you could, but most people don't. The principal balance increases each month, so technically it is a negative amortization loan. You are still issued a monthly statement each month, so again, even though no payments are required, you will always be able to keep track of your outstanding balance and any line of credit that you may have. Okay, types of reverse mortgage. As we mentioned a minute ago, FHA does the vast majority. The FHA loan is called the HECM, which stands for Home Equity Conversion Mortgage. FHA reverse mortgages are insured by FHA, which is a sub-agency, if you will, of HUD, the Housing and Urban Development. They are non-recourse loans, which mean you can never owe more than the home or the house is worth. As an example, let's say there's a huge market crash and the values plummet and you owed $200,000 and now the house is only worth $150,000 and you want to sell. Well, you are not responsible for anything more than the home is worth. That's where the FHA insurance comes in and would repay the lender. Anything above $970,800 for values greater than that, most of those would be proprietary or jumbo products, in other words, not FHA. So let's go through some real life examples here. These are loans that I've actually personally done or been affiliated with over since about 2007. So the first one we actually ever did was out of our Las Vegas, Nevada office, and there was a 62-year-old lady that worked for the city. She had no children and no heirs, and she wanted to retire at 62. She owned a condo. She still had a mortgage and a payment. So in this case, the reverse mortgage simply paid off her mortgage, and now she was able to retire with no monthly payment. Very simple. She was very happy. Another example we had sometime later was we had an 88-year-old lady that was confined to a wheelchair. Her granddaughter had taken advantage of her, basically had asked the grandmother to do some cash out so that the granddaughter could start or open a business. And of course, the granddaughter promised she'd pay it back. The problem was the granddaughter never made any payments, and several months later, again, the grandma was literally days away from a foreclosure. And we were able to step in with the reverse mortgage. We contacted the Private lender, once he knew we were doing the reverse mortgage, he had put a stay on the foreclosure for roughly a month. We were able to do the reverse mortgage, pay off the private lender, and again, she had no payment. So in that case, it actually saved the day. Another one. This is one I actually did, very personal to me. The wife tended to her sick husband. Every half hour she had to attend to his health needs. The wife got so run down because obviously if you're having to get up every half hour, you're not able to sleep. So she ended up in the hospital. And in this case, the reverse mortgage paid off the existing mortgage, which was not a big balance. But still, it paid it off. It also was able to pay her or them about $400 each month. So the combined cash flow of no house payment, which was roughly $400, plus the additional $400 she was able to draw each month from the reverse mortgage, that cash flow, they were now able to hire a caregiver 8 hours a day, so the wife was able to sleep. So again, this one literally was a lifesaver because the wife had gotten so run down as a caregiver. Another example, this one actually was my own mother. So she's gone now, but when she was 72, she wanted to retire. She still had roughly $1,000 a month mortgage payment. Social Security was not enough to allow for retirement, so we used the reverse mortgage, which frankly was a little bit short to pay off the mortgages. So she took out $30,000 from an IRA. So the combination of the $30,000 and the reverse mortgage eliminated the first and second mortgage, and my mother was able to retire and live comfortably with no monthly payment. Okay, let's move on. Sorry about that. And let's see here. We have one that was done fairly recently. 101-year-old lady lives alone and she needs in-home care. The house was worth approximately $325,000. It had been paid off for years. The problem was she was able to survive on Social Security at $1,500 a month, but when you need to start having in-home care, which probably averages close to $25+ an hour, that $1,500 does not go very far. So in this case, we gave her an initial lump sum of cash and a line of credit to provide for the expensive in-home care costs, and again, no monthly payments, because the alternative would have been to sell the house. Obviously, she would have walked away with $300,000 plus, but then she would have had to move to some kind of assisted living or something, and quite honestly, at 101 years old, that may have killed her. So in this case, she's able to remain in her home. Okay, now let's see the numbers. Here's just kind of a basic scenario, which is fairly common. The husband is 73, wife is 70, and by the way, they do go off. The numbers are calculated off the youngest borrower. FHA does require that you're at least 62 or older. If, for example, someone was 65 and the spouse was 59, there are ways to do that. However, for this scenario, we're going to assume they're both over 62. And the home is worth $400,000, and they still have a mortgage balance of approximately $75,000. So we've got this nice little pie chart here, and I like to look at it as the slices of the pie. So the first thing that has to happen is the over in the orange there, the $75,000, that does get paid off. That has to be satisfied. So $75,000 comes right off the top. And in the example that we have here, there's also the option, the little yellow slice of pie, they are, if they chose to, they don't have to, but they could pull out $17,344. And then they would still have a line of credit available for future use. And a nice little note on the FHA lines of credit is they do grow annually. The outstanding available limit grows by 4% a year. So if you don't touch it, it's similar to a credit card where they increase your balance, same concept, it does go up 4% a year. And as you can see by the green, there are still quite a bit of equity that would remain. Okay, so the results of that, they were able to pay off to $75,000. Again, they received $17,000 cash at closing. They have a $69,000 line of credit that will grow 4% a year. And now they can retire with cash in the bank, a line of credit for either leisure use or for emergencies such as a transmission goes out or air conditioning, something like that. And best of all, again, no monthly payments. Now, little known fact, you can buy a home with a reverse mortgage. A HECM for purchase, again, HECM is home equity conversion mortgage, is a reverse mortgage that allows seniors to purchase. It must be 62 or older. The home must be your principal residence. You can purchase a new residence using loan proceeds from the reverse mortgage coupled with a substantial down payment. Speaking of down payment, the required down payment is typically between 45 and 62% of the purchase price. Again, the variance there has to do with the age. The older someone is, the more they qualify for. In the reverse mortgage world, if you're only 62, you're frankly just a kid. These are all based on life insurance actuarial tables. They assume everybody will live to be 100. And so therefore a 95-year-old would qualify for quite a bit more than, say, a 65-year-old. So again, depending on the buyer's age, and the spouse's age, again, it's the younger of the two that it goes off. This range assumes the closing costs will be financed. The rest of the funds for purchase come from the HECM loan. This allows the buyers to keep more assets to use as they wish, compared to paying all cash while still having the flexibility of no required monthly payments. And here's just a small chart. As an example, a 62-year-old buying a house at $375,000, they would still be required to come up with about $222,000, but the difference of roughly $150,000, instead of being a traditional forward mortgage with a monthly payment, in this case it would be a reverse mortgage and no payment required. Protection of owing more than the value. A HECM for purchase, a Federal Housing Administration FHA insured program. HECM for purchase has a non-recourse feature, which again means the borrower can never owe more than the home is worth when the loan is repaid. The home is the only source of repayment regardless of the loan balance at maturity. A traditional mortgage, most do not have a non-recourse feature. Since home values can decline, the borrower could owe more than the home is worth, again with a traditional mortgage. So the next steps would be counseling. There is a checklist that was created to help you consider whether a reverse mortgage is right for you. A HUD-approved reverse mortgage counselor will help. There is normally a charge anywhere from $100 to $200. Every once in a while there's some grant money, and some of the counseling agencies will do it for free. So when you get the counseling list, you just have to, the best advice is just call and see if you do have anybody that will offer it for free. Questions, definitely, since this is a recorded webinar, feel free to contact me at my phone number there, 559-907-7215, or at bob@advisoryhomeloans.com. And again, we're located at 2560 West Shaw Lane in Fresno, California, 93711. And I wanted to thank you for sharing this roughly 15 minutes, and hopefully it's been educational. And again, feel free to reach out at any time with any questions on a reverse mortgage. Thank you and have a great day.